On October 19th, 1987, $22 billion vanished from the New York Stock Exchange in 6.5 hours. Not transferred, not stolen, vanished. By the end of that Monday, global markets had erased $500 billion, more wealth than most countries produce in a year. But here's what nobody tells you about Black Monday. Not a single dollar bill was destroyed. Not one gold bar melted. No factories exploded. The physical world remained exactly the same. Yet $500 billion had simply disappeared. This is the story of the greatest illusion in economics. And once you understand it, you'll never look at your portfolio the same way again. To understand where money goes in a crash, we need to confront an uncomfortable truth. Most of the money you think exists doesn't. Let me prove it to you. Apple is worth $3 trillion. But if every shareholder tried to sell their stock tomorrow morning, they wouldn't get $3 trillion. They wouldn't get $2 trillion. The very act of everyone selling would destroy the price before even a fraction could exit. That $3 trillion, it's not sitting in a vault. It's not in Tim Cook's desk drawer. It exists only as long as we all agree not to look for it at the same time. This is market capitalization, humanity's most expensive shared hallucination. Here's how the illusion works. When Apple stock trades at $190, we multiply that price by all 15.5 billion shares and declare Apple is worth $3 trillion. But that calculation assumes something impossible, that every share could sell for the last traded price. It can't. Only about 50 million Apple shares trade daily. That's 0.3% of all shares. The other 99.7% are just sitting there, wrapped in a price tag created by that tiny fraction. The tail doesn't just wag the dog. The tail is the dog. March 2000, the dot-com bubble. The Nasdaq had climbed 500% in 5 years. Yahoo was worth more than General Motors. Pets.com spent millions on Super Bowl ads while losing money on every sale. On paper, tech stocks were worth $6.7 trillion. Then someone blinked. On March 10th, the Nasdaq peaked at 5,048. By October 2002, it had crashed to 1,114. $5 trillion gone. But where did it go? Here's where most people get this wrong. They imagine money flowing from losers to winners, like a poker game where chips move across the table. When tech stocks crashed 78%, surely someone made 78% gains. No, this is the paradox that breaks people's brains. In a crash, money doesn't transfer, it disappears. Like a magician's trick in reverse, where the rabbit doesn't go anywhere. It simply stops existing. Let me show you the mechanics. Imagine a neighborhood with 10 identical houses. They rarely sell, but when one does sell for $500,000, every homeowner says, "My house is worth $500,000 too." The neighborhood's total wealth, $5 million. Everyone feels rich. Banks lend against this value. Families plan retirements around it. Then 2008 arrives. One foreclosure sells for $300,000. Suddenly, every house is worth $300,000. The neighborhood's wealth drops to $3 million. $2 million vanished, but nobody gained it. No burglar made off with $2 million. No bank account swelled by $2 million. The money was never there. It was always just the last sale price multiplied by faith. This is exactly what happens in stock markets, except faster and more violent. October 29th, 1929, Black Tuesday, the event that started the Great Depression. In one day, the market fell 12%. $14 billion destroyed. That's $200 billion in today's money. Panicked sellers dumped shares at any price. But here's the crucial detail. For every seller at those crashed prices, there was a buyer. Someone bought every single share that was sold that day. So did those buyers get rich from others' misfortune? Most of them were ruined within the year. They thought they were buying bargains. They were actually catching falling knives. The Dow Jones, which peaked at 381 in September 1929, wouldn't see that level again until 1954. 25 years of waiting just to break even. The buyers didn't win. The sellers didn't transfer wealth. Everyone lost because the wealth was fictional to begin with. But surely sophisticated modern markets are different. September 15th, 2008. Lehman Brothers, 158 years old, fourth largest investment bank in America, declares bankruptcy. Within hours, a chain reaction begins. AIG, the insurance giant that guaranteed billions in mortgage securities, needs an $85 billion government rescue. Washington Mutual, the largest savings and loan in US history, collapses. Wachovia, founded in 1879, is forced into a fire sale. Between September 2008 and March 2009, Global stock markets lose $30 trillion. $30 trillion. That's more than the GDP of the United States and China combined. Did it transfer to bondholders? No. Bonds crashed too. Did it flow to gold buyers? Gold initially fell 30%. Did it move to cash? The dollar surged briefly, then governments printed so much that cash itself became suspect. The money didn't go anywhere because the money wasn't real money. It was what economists call mark-to-market wealth, the practice of pretending that everything you own could sell for the price of the last transaction. It's like assuming every car in America could sell for the sticker price of the last Tesla. Mathematically defensible, practically absurd, but this raises an unsettling question. If most wealth can vanish without going anywhere, what exactly do we own? Here's the answer nobody wants to hear. You don't own 300 shares of Microsoft. You own the right to participate in a voting game where other players decide what those shares are worth. Every morning, global markets open, and $18 trillion in trades argue about prices. Not value, prices. The distinction matters. Value is what something produces. Price is what someone will pay. In bubbles, price detaches from value like a balloon floating away from a child's hand. In crashes, they violently reunite. Warren Buffett understood this 50 years before Reddit did. In 1987, while others panicked on Black Monday, Buffett didn't sell a single share. Why? Because he knew Coca-Cola would still sell the same billion servings the next day. The factories hadn't exploded, the recipes hadn't changed, only the price tag was different. But most investors aren't buying companies. They're buying price tags, hoping to sell those tags to someone else for more. It works brilliantly until it doesn't. Every crash follows the same pattern. First, a story captures imaginations. The 1920s. Stocks have reached a permanently high plateau. The 1990s. The internet changes everything. 2007. House prices never fall nationally. 2021. Cryptocurrency is the future of money. Second, leverage amplifies belief. People borrow to buy more. Banks lend against inflated collateral. Everyone's wealth depends on prices that depend on confidence that depends on wealth. A circular reference that Excel would reject but markets embrace. Third, a spark. Sometimes it's an event. Lehman's bankruptcy, the Thai baht breaking its peg. Sometimes it's just exhaustion. No more buyers at these prices. The reason matters less than the result. Fourth, the cascade. Selling triggers, more selling. Margin calls force liquidation. Stop losses activate automatically. Algorithms trained on historical data see patterns and react in microseconds. A crowd of humans and machines all racing for the same exit. Fifth, the disappearance. Trillions vanish, retirements evaporate, college funds dissolve, paper wealth returns to paper. But here's the psychological torture of it. The money feels real when you have it. Your 401k statement showing $500,000, that feels like 500,000 real dollars. You plan around it. You sleep better knowing it's there. Your identity adjusts to being someone with $500,000. Then 2022 arrives. The S&P 500 falls 25%. Your statement shows $375,000. Where did your $125,000 go? The answer is it went to the same place your children's imaginary friends go when they grow up. It returned to the void of never actually existing. This is why crashes cause such psychological damage beyond the financial loss. We're not just losing money, we're losing a story we told ourselves about who we are. So when a market crashes, where does the money actually go? It goes back to where it came from. Nowhere. Most market wealth is like your shadow. It moves when you move. It grows and shrinks with the light, and it seems absolutely real until you try to grab it. The $22 billion that vanished on Black Monday 1987, the $5 trillion lost in the dot-com crash, the $30 trillion erased in 2008, they were never there. They were prices multiplied by hope, calculated in spreadsheets, and reported as fact. The physical economy, the factories, farms, and workers, remains unchanged during a crash. What changes is the story we tell about what everything is worth. And when that story changes, fortunes evaporate like morning dew. This isn't a bug in the system. This is the system. Markets are voting machines in the short term, weighing machines in the long term, and imagination machines always. The wealth they create is real only to the extent we all agree to pretend together. But when that agreement breaks, when the spell is broken, we're reminded that market capitalization is just math, not money. Valuations are just opinions, not cash. And the biggest fortunes in the world can disappear without anyone taking them, because they were never really there at all. But here's the twist that changes everything. If wealth can be created from nothing, and it can disappear into nothing, then crashes aren't really destroying money. They're revealing that the money was fictional all along. The real transfer of wealth doesn't happen during the crash. It happens after, when assets are priced at their despair values, when everyone believes the world is ending, when stocks are sold for whatever cash can be grabbed. That's when real wealth quietly changes hands. The Rockefellers built their fortune buying during panics. Warren Buffett's greatest investments came during crashes. Every generational fortune was built on the rubble of someone else's paper wealth. The money doesn't disappear in a crash. The illusion does. And those who understand the illusion are the ones who profit from its collapse. So the next time markets crash and journalists breathlessly report that trillions were lost today, you'll know the truth. Nothing was lost because nothing was there. It's just the market's way of reminding us that prices are not wealth, numbers are not money, and the only thing that vanishes in a crash is the story we were telling ourselves. The money doesn't go anywhere. It was never there to begin with.